So what we're going to talk about in today's video is someone who got a whole life insurance policy recently, thought he got a good deal, but found out he got a bad deal. When he had reached out, he said this specifically: I signed up for a whole life insurance policy 1 year ago, and I was told that the policy breaks even in 3 years. Taking a closer look, it seems that the policy breaks even in about 10 years. What does that mean? Well, the break-even point is when your cash value is equal to your total payments. So what that means is when he first signed up for the policy that he had, he was told that he's going to have a positive cash value after 3 years, which is really good with a whole life insurance policy. But then after looking at the numbers, he found out it was 10 years. That's not good. So what we're going to do in today's video is look at the policy that he was sold, and then we'll look at an alternative that gives him a lot more cash value from start to finish. So a little bit of details first. He is 27 years old. When he started his first policy, he was 26 years old. So he had a whole life insurance policy. He wanted it primarily for cash value. He's a single guy. He owns his own business. He owns a marketing agency. He makes about $110,000 per year. So he's doing very well for an individual in his mid to late 20s. Like, he works hard. He's doing really good with his business. So cash value was his priority. Now, with his policy, he's not happy with it. What he did with respect to the funding is, in the first year, started with $25,000. Then the second through the 10th year, he paid $10,000. That's per year. And then from the 11th year onward, he paid the minimum premium, which was $3,500. So if this is you, and you got this whole life insurance policy, this means in the first year, you wrote a check for $25,000, and then your plan is to pay $10,000 per year for the next 9 years. Then after that, you'll continue to pay just the minimum premium. Now, there's some things I would definitely do different here, but we're going to look at that original policy. The thing I want to hit on first, though, is he mentioned that after taking a closer look, it didn't break even in 3 years. How long did he mention? Closer to 10 years. So in looking at it, it took about 9 years to break even, which is the first year he gets his money back. Now, he was told that he'll have a break-even point by the 3rd year. What do I have here? You'll have positive growth at the 4th year. Here's what I mean when I say that. I think he was told something more like that, because there are often plays on words in this business, which I absolutely hate, but we have to be aware of what to look out for. So here is the original illustration that he was shown. A lot going on here, right? Started at 26 years old, young, healthy guy, preferred rating. Total annual outlay. This is what he's paying into the policy every year. So in the first year, he pays in $25,000. And then through the 10th year, he pays in $10,000 per year. We've got this dividend column. You can ignore that. We've got this PUA cash value column. You can ignore that. Then you've got the total cash value column. Let's circle this in blue. We don't want to ignore that. And for now, we'll ignore everything else. Because he's interested in cash value, we're going to focus on that. So when he got this, he was told or led to believe that the policy broke even at the 3rd year. First year, he paid in $25,000. Second year, he added $10,000 to that. That means the total amount he paid was $35,000. 25 plus 10 is 35. He had 28, not the break-even point. Next year, he adds another $10,000. That means the total is at $45,000 that he paid in. His cash value is $36,000. That's not your break-even point. You're still about $9,000 less in cash value than what you paid in at this point in time. If we tally up the payments, and it's not until the 9th year where he would have paid in a total of $105,000, and now he has 106. So he breaks even or gets all of his money back by the 9th year. So why would an agent tell him that he broke even after 3 years? Because he doesn't, and it's pretty obvious if you look at the cash value. I don't think the agent told him that. Here's what I think happened, and I did speak with him about this too. The individual that bought the policy, not the agent. I don't know who the agent is. I think he was told that you'll have positive cash value growth after the 3rd year, beginning the 4th year in this particular case. Here's what I mean with this, because this happens so much when people are being educated on whole life insurance, and it can be confusing. Look at year 3. What's your cash value? $36,238. The next year, you pay in what? $10,000. Add $10,000 to $36,238. What do you have? You would have $46,238. But the next year, you've got a little bit more than that. So the 4th year is the first year that you got your full $10K back, plus additional earnings from the insurance company. If we look at the first 3 years, you got less than $10,000 back each of those years, meaning your full payment did not show up in cash value. So sometimes what we hear from agents is the 4th year is when you begin to have a positive cash value. They're referring to the positive cash value growth. In my opinion, what I think should be explained is, yes, at the 4th year, you start to see positive growth, but it's not until the 9th year that you finally recapture all of your money. Are you comfortable with that? Because I would not be, that's for sure. I want to recapture it much sooner. For him being a business owner, that's way too long to run a loss. From a lost opportunity cost standpoint, like, forget it. It doesn't make sense. So this is what he was sold. He reached out after examining it and wanted to look at some changes. So we looked at a new policy. Here were his goals. Number 1, maximize cash value. Number 2, use the cash value. Get as much as possible, get it compounding for me. Then when I use it for my business, I know it's still in the policy, compounding for me. That's the whole name of the game. So the funding that he looked at is similar to the original policy with a couple modifications here. First year, he wanted to pay $25K, just like the first one. Second year, he wanted to pay $20K. Third year, $15K. So he wants to be more aggressive the first 3 years. And then from the 4th year onward, really as long as possible, he wants to pay $10,000 per year, meaning he does not want to have to drop it down to a minimum after 11 years. He didn't have to with the other policy either. Sometimes that is used as a strategy to upsell additional policies after the 10th year. Sometimes it's after the 4th or 7th year. We hear encouragement to policyholders to reduce the PUA payment, pay just the base, and then start another policy. When I look at maximizing the overall cash value, I say keep on stuffing an existing policy as long as you possibly can. That's going to give you the most money whenever you look at a policy. So here, we're gonna have $10K per year through the 25th year, and then I'll pay just the minimum premium. So let's look at that, and then we will answer some questions here. So, beginning with the illustration. There was the old one. Let's look at the new one. Here we go. Stereo instructions, right? We're gonna look at this on Excel, don't worry. But first, I just wanna break down where our money is going. This way, we can see it on the actual illustration. So here's the funding, 25 in the first year, 20 in the second year, 15 in the third, and then 10 for a long time. Okay. Forget about all of that. If I see any amount of money going in, the question that I would ask if I'm you, or if I'm your independent third-party advisor that's sitting on the same side of the table as you, speaking with an insurance agent and making sure the policy is set up correctly, I would ask this question: where's my money going? Here's your premium, minimized. We also have this guy. This is a term insurance rider. So the true minimum is technically this plus this. Then what's highlighted in yellow is your paid up additions rider, what we like to refer to as a cash dump in, because it feels like you're dumping money into the cash value and then it's snowballing and you've got a lot more money to work with. Here's your net cash value column, which when we look at the Excel sheets, you'll see the numbers match up with what we're looking at here. Okay, so much more efficient policy. You'll see exactly the break-even point and such in a minute. We're going to go through questions that he asked and then also questions that we mentioned during the meeting. Here are some questions I would ask if I were you, or if you and I flipped positions. It's one of my favorite things to say because it just helps someone see things from a third-party perspective, because we want to know what questions to ask. So, first question, what is my minimum? What's the minimum with the new policy? Let's take a look. We saw that it was the premium plus the term. If we look at the true minimum, which is just the base premium, let's take a look. It's just about $2,500. It's actually slightly higher than that, but we're just rounding. The true base premium is $2,200 and change. With the term, might be a little bit higher than that, but it's going to come out to about that dollar figure. So the minimum, $2,500. Okay, so let's do this. What's my minimum? Answer, $2,500. Okay. What's the maximum? What is the maximum? Well, the maximum with this illustration is $25,000 per year. How we came up with that number, what do you notice about this and this? Are they similar dollar figures? Yes. The one on the bottom is the one on the top times 10. So the most we can illustrate going into PUAs every year is whatever our base premium is times 10x that. And that's how we came up with the $25,000 per year in this example, as far as the most that can go in. You can actually add a larger lump sum in the first year if you'd like, but as far as the most we can illustrate every year, beginning the second year, $25,000. This is the key right here. Whenever we look at designing a policy, we'll set the minimum typically as low as we can with the top companies. That's going to be around a 10% minimum premium. So what a lot of people like to do is exactly what he's doing, where he can commit to $2,500 per year and then add up to $25,000 per year. So now he's not on the hook for a $25,000 bill every single year, or even a $10,000 bill every year. He's on the hook for $2,500, and the rest can be added at his discretion. Make sense? Cool. All right, next question. What's my break-even point when we look at this? Let's take a look. We've got the illustration, but we're going to make it a bit easier here. So annual funding shows how much you're paying every year in blue. Okay, so that's great. Let's look at this. Total funding is going to add up all of the annual funding columns. So first year, 25, there we go. Second year, you added 20. 20 plus 25 is 45. Next year, you added 15. 15 plus 45 is 60. See what's going on here? How it tallies up the totals? And then the break-even point is just about year 4. Look at that. You've paid in 70. You got 69, 696. And then in the 5th year, you've got a positive cash value. That's your break-even point between years 4 and 5 in this particular example. You're going to see one that looks a little bit better in a couple minutes. But the break-even point is between years 4 and 5 in this particular example. Break-even is when you get all of your money back, just to simplify. So just about 4 years, but we'll go 4 to 5 years. What is my net rate of return? So the illustration that he's looking at has a dividend rate of 5.9%. That's the dividend interest rate for 2024. Is his money, though, growing by 5.9%? If we go back to that illustration, let's take a look. Well, before we pull up the returns, let me just ask it this way. If you put in $25,000 and you have $21,873, did you earn anything or did you lose money? You lost money. You had a negative return. So whenever we look at the returns, I don't really like to look at the dividend rate because it can be confusing. Instead, we look at the annual IRR. We could also call this annual ROR. ROR is rate of return. IRR is internal rate of return. But the first year, we paid in 25, we had 21,873. It's a negative 12.5% return. No matter how we slice it, we lost money in the first year. The second year, well, first off, let's look at year one. You're at 21,873. You added 20. If I just add 20 to that number, what would I have? 41,873. But I have 42,272, which means I got my 20K back plus a little bit more. That's why I'm no longer in the red that year. So my positive cash value growth is 0.095% in the second year with this product and design, as opposed to the original policy wasn't positive until the fourth year. If I'm in the red, that means I'm not getting all of my payment back. If I'm in the black, I'm getting the amount I pay into the policy back plus interest on top of it. Then it gets better and better from that point forward. So again, we've got the returns that are compounding down here, getting stronger and stronger. But watch this. Remember where we said the maximum you can pay on any given year is 25K per year? Check this out. Here's the same exact policy. He doesn't have to choose if he's going to do this up front. But what we're going to do is just max fund it every year. So if things go well for him in his business and he says, hey, I can pay more than the anticipated 10K per year, can I add more to this? Even though the plan was to do 10, can I do 25K per year? Because that's what you said my maximum was? Yeah, you can. And what happens to your returns when you look at this? By getting more money into the policy faster, that is going to enhance the internal rate of return. When I look at the growth rate, stuffing money into PUAs is going to do that. And you can see it when we look at the exact same product with the exact same company, just paying more money in, I get more cash value as a result, which is fantastic. So what is my net rate of return? I would not look at the dividend rate. For him, it's going to fall somewhere between 4.5% and 5%. With the option we just looked at, it peaked right around 4.5%. I'll show you one that gets you closer to 5 in a little bit. What if you don't like the percentages? What if you find percentages confusing and say, can I just see my growth in dollars? How do I look at the cash value growth? This one's pretty simple. Some insurance companies will include this on reports. Some insurance companies do not, but you can take any illustration, put it on Excel and easily see the numbers. You could also do it with a calculator. I'll show you how to do that too. But let's do this. Let's look at this illustration, which is the 10-year fund, and start with what we just looked at. So there's the annual growth rate in percentages. And now we're going to look at the same thing, but with dollars. So what we look at, let's first look at it with a calculator. In case you don't really like Excel, this will be a nice, easy way to do it. So we've got our handy dandy calculator. Here we go. Here's what you want to do. The first year, take what you paid in, or I should say your cash value minus what you paid in. So take the 21,873 minus $25,000. Negative 3127. That comes out to that negative 12.51%. Now, for the second year, what do we want to look at here? I'm going to take the year 2 cash value of 47,230 minus the first year cash value, 21,873, minus the second year payment of $25,000. There we go. And the growth is $357. And then we would do that every year to see the year-to-year growth. Now, here's a much easier way to do it. You use a program that does it for you, and you just know what buttons to push. All right. So now, there we go. So there's the 357. But when we look at it each year, this is showing exactly how much money we get from the insurance company each year. Because whenever I look at the cash value growth, what I don't want to look at is the growth with my payments. Meaning I don't think it would be fair to say, hey, I was at 21,873 last year, and the next year I'm at $47,230. My policy grew by $25,357. Wow, what a return. No, 25 of it was your money, so that doesn't count. I just want to know exactly what I got from the insurance company. It drives me nuts when I see that happen. It's like, that's your money going in, right? Who's taking my money? All right, and then we've got, after this, we pay 0 in, and the cash value keeps on growing. So that's how we can look at the net cash value growth whenever we look at a policy. Here, I'm just going to put calculator or Excel. If you want more information on that, feel free to shoot us a note. Always happy to help. And then lastly, can I do anything to improve the policy performance? Yes, you can. In this particular case, we already looked at adding more money to the policy. So if I max fund it each year, that will improve performance. Here's something else you can do. So when we look at the returns here, let me go back to tab 1 actually. Keep these numbers in mind. See the returns down here? Like if you look at age 40, you're at 3.75%. And then the example where you max funded it, you're at 4.44%. Keep that in mind. Okay. What we're going to look at here. Same product, but with a different PUA rider that takes more of our money up front, which I don't like. So instead of a 12.5% hit, we've got a 17% hit. Second year, we're -2. But then look at age 40, 4.14%. And then look at the example where we max fund it. Remember where we mentioned the growth rate between 4.5% and 5%? So now by looking at a different product, he gave some money up front, but he got it back long term. Question is, when we look at this one compared to the other guy, do I value the additional 0.5% in long-term growth more than I value the upfront cash value with the other option? Depends on how much of the cash value you want to use up front. A lot of real estate investors and business owners we work with tend to select the first option we saw because that gives them an earlier break-even point and access to more money, and they feel they can earn a much higher return than the extra 0.5% they'll get with the insurance product with the other option. But then some say, I'm not going to use all of my money, so I'm okay going with the other option. But the answer to that question, can I do anything to improve performance? Yes. you can max fund or look at additional products that are designed for better long-term growth. And that product was the same. It was just a 10% PUA fee instead of a 5% PUA fee. So back to the question, how do I get a better deal? Ask the right questions or have someone ask those questions for you and look at different illustrations that display max funding the policy up front to improve the break-even point, and really just ask your agent enough questions until you see a design that you're comfortable with. If you see designs that don't give you the cash value you want up front, even if it's not possible with a life insurance policy, but it doesn't fit for you, that's okay. Don't feel like you have to move forward if it's not a fit for you. I'll close with this. I remember meeting with a guy, he's same age as me, invests in real estate, has money in the stock market, does really, really well. He started a policy with a lump sum of about 150 grand. He wanted to be able to pay up to $100,000 per year thereafter. Took him a long time to decide, but during that time, he said, hey, everybody's telling me I should be looking at this differently. Like that I got to change the way I think because that's what you're supposed to do with these policies. I'm like, you could do that. And I hear that all the time too. But where you're at right now in life, like you've done well financially with what you've been doing. So I wouldn't abandon ship with what you've been doing. Here's what a lot of people do that are in a position similar to you. They put money into their cash value life insurance product because they typically see it grow at a stronger rate than what they get in their bank account. You've got the tax benefits, but really they can easily borrow against their policy for real estate. They view it like their own personal line of credit. So I might look at it that way and then keep doing exactly what you have been doing with the market and real estate. And if this can make your life better by using this as a line of credit instead of just using cash or dealing with a bank, that's where you could find yourself really liking this because you'll be able to move faster. But I wouldn't move forward just because other people say this is the way to do it. It's got to make sense for you, and you have to be comfortable with it, because if you're not, that's typically where people doubt themselves and eventually cash out the policy. So with that said, I'm going to stop rambling now. I do hope that you enjoyed this video. Let us know your thoughts. Feel free to leave any questions or comments below, and we'll talk to you soon. I hope this helps.